to be dealing with fixed assets. So now, what are fixed assets? Fixed assets are assets that will be used for more than 12 months or more than one financial period. As you may know that in accounting we have 5 elements, which are assets, equity, and liabilities, and then income and expenses. Assets, equity, and liabilities form part of the balance sheet statement, and then income and expenses form part of the income statement. So now we have types of fixed assets. Types of fixed assets include equipment, vehicles, land and buildings. So now let's look at this picture and classify each picture under those assets. So we have our laptop, our computer here, which is equipment. And then we have an aeroplane, which falls under vehicles. We have our chair here, falls under equipment, and all this also fall under equipment. Then we have our factory building here, falls under land and buildings. Now we have under assets, current assets and fixed assets. So there's a difference between current assets and fixed assets. Current assets include cash, petty cash, cash equivalents, accounts receivable, allowance for bad debts, accrued interest income, advances to employees, inventories, prepaid expenses, unused supplies. And then non-current assets include land, building, equipment, furniture. So the difference is that for non-current assets, you are expected to use these assets for more than 1 year or one financial period, as we have said in the previous page. Will be used for more than 12 months or one financial period. Then we have current assets, which will be used within the financial period. For example, if we purchase a vehicle and then they tell us that it is expected to be used for 4 years, then the vehicle will be classified under non-current assets. But then if we are an entity or a business that sells cars, we buy a car and then we can sell the car next month or next 2 months or in the next 3 months, then the vehicle is no longer a non-current asset but a current asset because it is inventory. We sell cars. It's sold within 12 months, not after 12 months. And then we also proceed to say fixed assets lose value over time. So now the word that we use for the loss in value is depreciation. So fixed assets depreciate, and also fixed assets can be called non-current assets or tangible assets. So depreciation is an expense and its contra account is accumulated depreciation. So accumulated depreciation is a temporary account, as you can see here. Then depreciation is an expense. It is debited when you record in the general ledger because it is an expense. So you debit with accumulated depreciation, which is our temporary account. So now we have also what we call useful life and residual value. So useful life is the time that the asset is going to be used for before it is scraped off, or time until full depreciation. So if there's a scenario that says a vehicle was bought and it has a useful life of 5 years, means that is the time that the vehicle is expected to be used. After 5 years, we should no longer use the vehicle because it has fully depreciated. It has depleted its useful life. We can use the vehicle or the asset, but then we need to determine another useful life for the purposes of depreciation. So now we have the residual value. The residual value is the current amount that you would receive when you sell a fixed asset at the end of its useful life. So now this essentially means that when you buy a vehicle, you need to know what amount you'd sell it when you dispose it. So let's say the vehicle will be sold after 5 years. So after that 5 years, when the depreciation is full, when the useful life has depleted, when the vehicle has fully depreciated, how much are you going to sell the vehicle? That is the residual value, the current amount that you will receive when you sell a fixed asset at the end of its useful life. So if you don't understand this, text me, chat with me, contact me. I'll explain this to you further. Now we have methods of depreciation. So methods of depreciation, we have the straight line or cost method. If they say the vehicle is depreciated at cost method, just know that it's the same as straight line method and vice versa. And then diminishing balance or carrying value method. This is the same as saying carrying value method when you say diminishing balance method. So now let's look at how you calculate using the straight line method. You take your cost, you less your residual value. If you are given a residual value, you less your residual value. If there is no residual value, you take the cost, then you multiply that by your percentage. And then for the diminishing balance or the carrying value method, you take your cost and you minus your residual value first, and then you also minus your accumulated depreciation. So cost minus residual value minus accumulated depreciation. If there is no residual value, cost minus accumulated depreciation, then you get your carrying value. This is how you get your carrying value. You take the cost, you less accumulated depreciation, then you multiply by your percentage. You'll be given a percentage, so you multiply by that percentage. Now let's look at an example where they say they bought a vehicle on January and on September, so the financial year end is December and starts from January. Remember that the financial year end can vary. It can start at any month or in any month of the year. So let's look at an example where the financial period started from 1 January and ended on 31 December. And then the vehicle was bought on September, 1 September, the 1st of September. So now to calculate the depreciation, you need to use what we call pro rata, meaning that you need to take the portion of the months the vehicle was to be depreciated. So from September you count September, October, November, December, which is 4 months. So now you're going to do pro rata. Out of 12 months, how many months did the vehicle depreciate for 4 months. So you take 4 over 12 and then you get your answer. And then also on the diminishing balance method, you do the same. Then you get the answer. Now let's go and look at an example. Let's now look at an example. They say depreciate vehicles at 10% per annum at cost price, and then equipment at 10% per annum at carrying value. So now let's go and look at our pre-adjustment trial balance. Our pre-adjustment trial balance says our vehicles was 100,000 rands cost. This is the cost of the vehicle. And then they said depreciate vehicles at 10% per annum at cost price. We use the first method of depreciation. So you take that 100,000, that cost, and then you multiply by the percentage. Your percentage is 10%. This is the 10%. Then you get 10,000. This is for vehicles. Then for equipment, you go and look at your cost. The cost of your equipment was, where's your equipment? This is the equipment. So the cost was 75,000. 75,000, then you less what? Your accumulated depreciation. We haven't been given the residual value, so you don't less the residual value because you don't have the residual value. So equipment cost, then the accumulated depreciation on equipment was 30,500. I hope you can see it here. This is the accumulated depreciation on equipment. Because we are using the carrying value method, the carrying value method says cost minus accumulated depreciation times the percentage. So your cost was 75,000, you minus the 35,000, you get your 40,000. Then you multiply by your percentage, which is 10% here. Then this is your depreciation, which is 4,000. Your total depreciation for the year will be 10,000 plus 4,000, which will result in 14,000. So when you record in the general journal, you debit depreciation 14,000 and then you credit accumulated depreciation 14,000. If you need clarity or need more lessons, please contact us. Go to YouTube, search for Bricks2, subscribe, and then you'll find more videos there. Thank you.